Erik Nelson of Wells Fargo says the US 10-year yield is simply too low. He says the following: real yields need to be higher for the Fed's policy to be sufficiently restrictive to bring down inflation. The 10-year nominal yield should trade up to 4.25 to 4.75 through early 2023. Erik joins us right now. Now, Erik, I've got to go straight there. 4.75. We haven't even seen that this year, and we just about saw it on a 2-year. Why are we going to get 4.75 on a 10-year anytime soon?
Well, John, it helps to do a bit of a gut check as to what this environment looks like versus the environment of 2018, when 10-year yields were just 25 basis points lower than they are now. You have central banks everywhere tightening very aggressively. Yes, they've slowed the pace a little bit, but the level of yields and rates in these central banks is so much higher than it was back in that period. Inflation compensation is simply too low. We look for some risk to the upside there. And you also have central banks reducing balance sheets, doing quantitative tightening nearly everywhere in 2023. It's a very different environment than 2018. So both on the real yield side and on the inflation compensation side, we look for significant upside in yields heading into next year. We think 4% will be more of a floor than a ceiling for the 10-year yield.
So let's breathe some life into this conversation and start at the very, very front end, Erik, and then we can push that out to the 10-year. Erik, where is Fed funds in that world next year? Just how much upside do you think there is?
Well, our call, John, is for the Fed to raise rates to 5.25 starting in the early part of next year, so 50, 50, 25 at the next 3 meetings, and holding rates there for the entirety of 2023. So we have no rate cuts in the forecast for 2023. The labor market is stubbornly strong, as you discussed with your last guest. We certainly saw that in the earnings number last week, and continued strength in payrolls. So the Fed's going to have to keep policy uncomfortably tight for an extended period. And to us, that means there's still a lot more room for upside, both in the front end and the back end, but probably more so in the back end heading into next year.
Erik, can you explain the back end? So as we start with the 2-year, I get it. If you think Fed funds gets to 5.25 and has to stay there, the 2-year's got some work to do. I think we're on board with just the logic of that. Push that out through the 10-year. Why does that lead to higher 10-year yields and not lower yields in anticipation of the economy ultimately rolling over?
This is a different regime, John, than we've seen in the past. It's very possible that the Fed does cut rates, maybe not necessarily next year, but in 2024 and beyond. But the odds they cut rates back to 0 is very low. So the floor for rates, let's say 3, 4, 5 years out, is much higher than it would have been in past cycles. And that really comes back to this idea of continued supply shocks, stubbornly high structural inflation. So we see it both in terms of the actual level of policy rates further out the curve in real terms, but also in terms of inflation compensation. That's still, from our perspective, just too low, given the inflation risks are still skewed to the upside over the next 5 to 10 years.